Here are my top 8 stocks to buy right now. We'll go over one stock that I own, followed by one new stock to keep it interesting, as we work our way up to my largest position and my favorite stock to invest in right now that's increased a crazy 100% in the past year. Hopefully this list gives you some ideas for your own stocks and a starting place to do your own research deeper into these companies. After all, just one great stock pick could change your life. Just look at Warren Buffett. As always, I'll put my money where my mouth is and show you my actual stock portfolio. So here are my stocks. They're up around $36,000 over the past 6 months. But as you can see, you can have pretty big swings even on a daily basis. And even in this chart, we can see my portfolio peaked in early February at over $200,000, but since then it's declined down to its current price of $186,000. That's the price you pay with these kind of stocks. High volatility, but potentially high reward. And stick around until the end to see my full list of current stock investments, as well as any trades I've made in the past month. The first stock has exploded into my portfolio and it's now my second largest position overall. That company is Google, and even though it's not my largest position, we'll get to that later, this stock has still managed to increase in price by over $500 million in the past year. And we'll be looking at this company through two different lenses: its current technology and its future potential for growth. So Google is a really big company. They made over $300 billion in 2023 alone. But what's more interesting than that overall number is to see where that money actually came from. Google will actually tell us how much money came from Google search, for example, which was $48 billion, versus YouTube ads at $9 billion. But for this breakdown, we're going to be focusing on this line item all the way down here, Google Cloud, where the company made $9 billion on it in their most recent year, compared to just over $7 billion a year ago. The reason is, this is one of Google's fastest growing areas of the company and the one that has the most potential to grow the stock going forward. So let's start by looking at where they stand currently. Google historically has been the leader in AI. They've been making AI for consumers basically as long as it's existed, and more recently, they've been pushing heavily into the area of generative AI, which means it was a really big deal when OpenAI came onto the scene launching ChatGPT, which basically monopolized the generative AI market overnight. And this was a problem for Google at the time. See, Google Cloud is like the other big cloud providers like AWS or Microsoft Azure. Their job is to let other companies run their applications on top of Google's hardware. So if I'm, I don't know, Coca-Cola, I don't want to run my own servers and pay to protect them, to cool them, to upgrade them all the time. I'd much rather just build the applications and then run them on someone else's servers. This is the whole value of the cloud. But Google Cloud specifically is one of the smaller cloud providers. AWS owns 31% of the market, Azure owns 24%, but Google Cloud is less than half of Azure at 11% of the market. And while they're still far ahead of the runners-up, they're by far the smallest of the big three, which means that their main value proposition has been that they're really good at their one specific niche of AI. Just look at Google Cloud's website. Most of the products that they're talking about on the front page of Google Cloud is around artificial intelligence. It's the first category they have listed. If you were to look at this same site for AWS, you're going to see much broader solutions mentioned because AWS is the biggest. But if Google Cloud is mostly known for AI and OpenAI, the inventors of ChatGPT, have now partnered with Microsoft Azure, doesn't that mean Google Cloud is out of the running? Well, for a while, people thought that might be true, but things are starting to change. When ChatGPT first launched, it came out of nowhere, and Google was kind of caught with their pants down. Eventually, they were able to launch Bard, which caught them up a little bit, but then GPT-4 came out. At this point, Google was 6 months behind, but then they launched their Gemini Pro model. This was a project as part of Google DeepMind, which is their research and development platform, and this basically caught them up with where GPT-4 was. But then after that, they launched the Gemini 1.5 model, which was actually performing above GPT-4 in several categories. And at this point, the two models basically trade off back and forth which categories they beat the other in. But here's why that's important. If Google started out 6 months to a year behind where OpenAI was, and they're now competing neck and neck with them, that means that they've moved faster on their R&D than OpenAI has, which means while they're behind, they are catching up. So here's why I'm investing in Google going forward. Out of all the big cloud providers, Google, in my opinion, has the most depth of AI available. We saw some of it in their Google Next conference, which happened just a few weeks ago, where they talked about new products that they launched, including a product that could write songs for you, as well as all these different categories that AI could be used to actually solve problems for companies. So here's the basic thesis with Google. As their AI becomes more and more advanced, big enterprise customers are going to be looking for who can use AI to solve their problems most effectively. And because Google has both generative AI and just traditional machine learning expertise, a lot of those problems are going to be addressed by Google the best. And then once they have their foot in the door, there's no reason for them not to use more of the Google Cloud services and basically upsell them over and over again until they make a substantial amount of their revenue from Google Cloud. And given their current growth rate in this area, that seems like that's already happening. Now, do I think Google is going to pass Microsoft Azure and AWS as the biggest cloud provider? No, I don't really think so. But even if they never pass Microsoft Azure, that still means Google Cloud has room to double their market share, adding an additional $9 billion in revenue onto what they already have, which is starting to be enough to actually move the needle for Google as a company, which is why I own 123 shares of the company, currently valued at around $19,000, and that's up around $3,000 overall. And we'll get to this stock a little bit later with the $16,000 rise. But that's a massive company, so upside can be kind of limited. So let's now turn to a much smaller stock that has more potential to rise quickly, and it's operating in the growing space of automated software, GitLab. GitLab is one of those stocks where if you're in the know, you know, but a lot of people haven't even heard of this stock before. So let's start there. GitLab is a continuous delivery software solution, which, to make it simple, is basically built around making software faster, making it easier to develop new software. And they talk a lot on their website around how they're starting to offer AI-powered workflows to help boost efficiency and reduce cycle times. So when you have a team of developers building an application together, one of the hardest things to do is make sure everybody's collaborating effectively, because you're working way down in the weeds and everything needs to work with each other. Continuous delivery is a solution for making sure this works. So anytime you make a change to the app, you can upload your code, it'll automatically get matched to see, does your code conflict with any code that was already written? You can run security scans, do automated testing, and even deploy the app automatically into the world. Companies like Netflix make something like 200 changes every day, and the only way that's possible is through continuous delivery. And GitLab is one of the biggest platforms for this in the entire world. Their stock price is currently up 64% over the past 1 year. But if we look at just the year to date, we can see that they had a pretty massive drop in their stock price after March 4th, down around 28%, which is in part due to a little bit disappointing earnings that they reported in their most recent quarter. Now, the company's worth around $8 billion, but they're not yet profitable, and while they are growing very quickly, their revenue is only at $160 million per quarter, so around $600 million for the entire year. And so even though their most recent earnings weren't bad, the market was basically pricing in perfection from this stock. But here's why GitLab might have substantial room to grow from here, so that we can hopefully get in on the next 63% rise in the stock price before it happens, like the members in my private stock group did when one of our members did a write-up on GitLab back in 2023, which, along with some of the other stocks we've talked about in that group, have made some of their investors a pretty good return. So GitLab's biggest competitor by far in its space is Microsoft, who is the owner of GitHub. It's a very similar name, but GitHub is focused more on the storage side of code, and then they've moved into continuous delivery, while GitLab was continuous delivery first, and they support storage. Currently, GitHub is the bigger platform, boasting 56 million users versus GitLab's 31 million users. The only issue is, in order to invest in GitHub, you also have to buy all of Microsoft. And I can tell you what, the $62 billion in Microsoft's revenue isn't going to be moved that much by the revenue from GitHub, which is also why when you invest in Microsoft, you're stuck with your 17% growth rate year over year versus the over 33% growth rate that GitLab is currently experiencing. And the reason GitLab may accelerate its growth from here is because it's starting to be able to build AI directly into their tools. You may have heard of Microsoft Copilot, which works with things like Microsoft Office as well as GitHub, but GitLab has their own version, which they call GitLab Duo. Basically, this is an AI that was trained on millions of lines of code to proactively spot issues and make recommendations to developers in real time. I can tell you as someone who's used services like this is super helpful, and it does speed up your development time. And considering how expensive developers are, that can save companies a ton of money, so they're willing to pay for it. And that's not even factoring in other workflows, like imagine the ability to translate from one language to another, or to automatically upgrade your code with the latest security patches, all provided by generative AI. Basically, all the mindless parts of coding automated. Now, this stock's probably a bit of a binary outcome. I think it'll either do very well or pretty poorly overall. But let's turn to a stock that I have more confidence in. In fact, it's a stock that I have enough confidence where I've added just under $10,000 to the stock in just the last 2 weeks. And that stock is Palantir. Palantir is currently one of the most talked about stocks in the entire world, after increasing in price by 144% in just the past year, with these massive increases in their stock price after they report earnings. And there's good reason that this stock has gotten so much attention. Palantir is growing their US customer count 55% year over year, increasing margins, making more net income than ever, and launching tons of new products. But the market may still be undervaluing this secretive tech stock, and let me explain. Palantir currently has 3 products. The main one is Palantir Foundry, which is basically a way to organize companies' data for them in a way that they can use effectively. On top of this, they have Palantir Gotham, which is basically data analysis on top of the data that's already organized. And then the last product that they had for a long time was Apollo, which allows them to deploy software basically anywhere in the world. It's kind of like GitLab in some ways, but for the CIA and military-industrial complex. But the real reason Palantir's growth has been absolutely exploding recently is because of their latest tool that they've launched called Palantir AIP. AIP is their new AI platform using generative AI to automate tons of aspects that they've never been able to do before. Look, Palantir's real value is that they can organize data for organizations where data leaks are national security issues. They're incredibly secretive. And it sounds like, oh yeah, you just put that data into an organized system. But that's really hard to do. Palantir had to get a bunch of engineers with high-level security clearances to basically go into an organization, get all their data organized for them, and then they could offer the valuable data analytics. But that takes a long time, and that's really expensive, which is why Palantir spent so much money on stock-based compensation, which was like a weight that was dragging down the stock price. But AIP lets you automate a ton of that process. Instead of having an engineer have to go and read through a million PDFs to find what's useful, generative AI can automatically search your existing data, identify the exact line in a document that's relevant to your question, and pull that out for you. So you can use generative AI to take your disorganized, unstructured data and turn it into very nicely structured data like Palantir Foundry requires. And it seems to be working. Back in October, they had a goal of running 500 AIP boot camps, basically quick sessions with companies to show how valuable they are. As of February, they had already completed 560 boot camps, and customers are really happy with the results that they're seeing. Now, to be clear, this is a very expensive stock. They have a forward PE ratio of 62, which is one of the most expensive in the entire market. But that's also because they hit all the requirements that most investors have. They sell something that's really hard to replicate because most companies don't have security clearance to do what they do. What they sell is extremely expensive, and now that they have generative AI, it's easy to replicate, which would make Charlie Munger very happy. But next, let's look outside of tech stocks and into an investment that's diversified away a little bit more. That way, if the Fed gets frisky with inflation rates and tanks the market, this $1 million asset can continue to appreciate at its own pace. I'm talking about the world of fine art. Our sponsor at Masterworks has changed the game with art investing. It used to be that only millionaires could afford to invest and profit from investing in this market. But Masterworks has brought the power of fractional investing to the art market. For the first time, you can invest in art from legends like Picasso, Banksy, Basquiat, without needing to buy a whole painting. You might have seen my walkthrough video I did on Masterworks around 2 years ago, back when they only had 17 offerings on their platform. They now have over 300 in their collection, and that number will continue to grow throughout the year. Each of their 21 sales that they've made so far have turned a profit to investors, which is why over 900,000 users have joined the platform today. The only issue is, in the past, paintings from top artists have sold out in as little as a few minutes. But you can skip the waitlist and start investing today by scanning the QR code on screen or by clicking the link in the description at masterworks.art/fintech. Now, past performance is not indicative of future results. You can read all the disclosures in the description. But now let's look at a stock that has reshaped the way we buy products and even run companies, that has soared 38% in price since I last talked about them, but has strong momentum to keep on rising. Amazon. Now you may think you're already pretty familiar with Amazon, but I'm going to be looking at this stock a little bit differently from most investors. Amazon is such a large company that most of their value is pretty well weighed out. When you look at the stock price, you don't see a lot of huge ups and downs, and it's pretty steady because the market has a good indication of what the stock should be worth. So when investing in these multi-trillion-dollar companies, I only expect to make a profit if I can find an edge that the market is missing. Now Amazon is really a bunch of businesses in one, and their two biggest businesses are their shopping business, Amazon.com, and Amazon Web Services, their cloud infrastructure business. I talked about this a little bit with Google, but Amazon is in a different league. Their cloud business is 3 times the size of Google and is so large that companies like Netflix can just run directly on top of their services. And a few years ago, cloud was all the rage. That's all everybody was talking about. Then we had things like blockchain, then metaverse, then AI, which all kind of gained the spotlight. But people forgot that the cloud had continued quietly growing in the background. In fact, cloud infrastructure saw its biggest revenue growth ever in Q4 of 2023. That means that cloud growth is still accelerating even this late in the game. But I want to get really specific on what the cloud actually is and what the value is to companies, because that's ultimately going to dictate how much money Amazon can make, and will explain why I think the market is undervaluing Amazon Web Services. So any modern startup that involves technology in any way is going to use the cloud. They do this because generally using the cloud is cheaper than running your own infrastructure, just due to economies of scale, and you get the benefit of being able to scale up your applications as much as you want. Let's say I launch an app that has 100 users. I can just pay Amazon for the 100 users rather than going out and buying a $20,000 server. So I might pay a few cents for that. Then if the app goes viral and I get 5 million users, well, guess what? Amazon is big enough that they just scale with it. They don't care. And so it allows you to build a company from the ground up to a massive size, which is exactly what I did in this video when I built my own mobile app. But new companies is only part of the market. The other massive part of the market are legacy enterprises that are still running on their old servers that they bought 20 years ago and haven't yet moved over into the cloud. This is driving a substantial amount of the growth in the public cloud market, which Gartner expects to increase by more than 20% in 2024. That's 20% growth on top of a over $500 billion market already. And guess who's the biggest competitor in that market? Amazon. For a long time, the question of using the cloud was, is it more efficient? Does it save us a little bit of money? Is it easier to build on? But more and more, it's becoming a competitive disadvantage to not be on the cloud. All these latest Gen AI tools that are coming out, it's a lot easier to use them if you're already in the cloud where those services are run. It's honestly hard to imagine any company existing in 20 years that is not running on the cloud in some way. And even though $500 billion is a lot of money, it's nothing compared to the worldwide IT spend, which again, according to Gartner forecasts, is expected to reach $5 trillion in 2024, 10 times the cloud market. And because right now everybody's focusing on AI, which I do think is incredibly valuable, I think that there is an opportunity to invest in the really core, solid, growing cloud providers like Amazon, who will benefit from any tech trend that comes along. Blockchain, metaverse, AI, they all help Amazon. And so that's why I think Amazon is a solid pick for any portfolio. But let's now swing to the far other end of the scale, to a stock that's riding one of the biggest investing trends of the next decade, cybersecurity. And while this position is only 82 shares and $19,000, which is way smaller than my 8th stock, which we'll get to later, Zscaler has a very profitable niche that it is only just starting to exploit. Zscaler operates in the area of zero trust security. Basically, if you think of protecting a network, the old-fashioned model was a firewall, basically a moat around your entire company to keep the bad guys out. The problem is, if the bad guys somehow get into the company, they now have free to run amok and do whatever they want. But with zero trust security, every user, every computer, every application on the network has to authenticate anytime it talks to anything else. And what's important here is that is the way that modern infrastructure is going, and particularly companies that are deploying on the cloud. We already saw how fast the cloud market is growing. Well, the zero trust security market is basically keeping pace, growing 16.9% forecasted over the next year, with that growth fairly well spread out between North America, Europe, and Asia Pacific. And Zscaler is a leader in this area. area. Zscaler's stock price is up 67% for the year, hitting a peak right after their previous earnings call and then selling off slightly. So we have a little bit of time before their next earnings call to potentially get in and hopefully see a pop in the stock price after earnings. The company currently has a 117% dollar-based net retention rate, meaning for every dollar a customer spends this year, they can expect them to spend $1.17 next year. They also have very high gross margins at 81%. And if you're a growth investor, you might be familiar with the rule of 40, which basically says your growth year over year combined with your free cash flow should be above 40. And the company handily beats that, meaning they're not only growing, but they're throwing off a ton of cash as well, meaning they're not very likely to go bankrupt. And most important of all, they have over $2 billion in annual recurring revenue. Annual recurring revenue is way more valuable than a normal company, especially when you're investing in growth stocks. Think of it this way. If I had a company that sells plastic cups and I want to sell $100 million worth of them, well, I got to sell 100 million plastic cups. Then to grow 50% next year, I have to sell $150 million worth of those cups. But now imagine I'm Zscaler and I sell $100 million worth of my software. Because it's recurring basis, if I want to grow 50% next year, I only have to sell $50 million, 1/3 of what I have to sell for the cups, because that first 100 million just carries over automatically. This is why so many rapidly growing companies have recurring revenue. And it's also why if we look at the company's revenue, they made $500 million in their most recent quarter, up 35% year over year. And while they're still net income negative by a tiny amount, that has been growing even faster. And more importantly, they have positive free cash flow, meaning even if the company doesn't make a profit on paper for a long time, they have real cash coming into the business that they can use to run operations, which I personally think is more important than profit. And Warren Buffett happens to agree. But moving on now to a brand new stock that I've never talked about before on this channel, that's recently had a renaissance in its stock price after the application of generative AI. That stock is MicroStrategy, which is up a ridiculous 260% over the past year, but it's also pulled back by around 38% since its peak back in March, which might give investors a chance to buy in, or it could be a bear trap and a falling knife that we want to avoid. Let's take a look. MicroStrategy bills themselves as AI available today. Of course, every company is doing that now. What MicroStrategy really is an intelligence platform, which is really a fancy word for data analytics. But they are incorporating AI-powered workflows as well as their traditional technologies to try to speed up the time from data to taking action. So if you're looking for a chance to invest in a very pure play data and AI company, this is one of the better options out there, which is probably why, if we zoom out enough, this stock price has been ridiculously volatile, having a huge jump back in the dot-com boom, rising slowly throughout the years, seeing a pretty big jump in the 2020s, and then seeing a big spike more recently. But the question is, can they sustain that spike? Is this all hype, or is there actually value behind this $20 billion stock? Well, a few things up front. Their forward PE ratio is probably the highest that I've ever seen at 708, although this could just be because the company isn't that profitable yet. So instead, if we look at their price to sales ratio, the company's valued at 44.5, which is very expensive, meaning we're paying a premium for this stock, and so we would expect their performance to be premium as well. For comparison, Google's price to sales ratio, which is basically their market cap divided by their revenue, is 6.29, so around 1/7 as high. So let's look at the company's earnings to see what might be going on here. We can see that a year ago, they were growing their revenue at 2.1%, which is not a premium company. Then they grew at negative 1.3%, 3.2%, and then negative 6.9%. So far, things aren't looking great for this stock. On top of this, their net income seems to have dropped from a year ago, down to 89 million. And perhaps most importantly, they don't have consistent free cash flow. One thing that is positive around this stock is they have relatively high gross margins at 77%, although these are lower than a company like Zscaler, which is also growing faster. So then the question becomes, why is this stock, which seems to be shrinking and has lower gross margins than Zscaler, valued at $21 billion, when Zscaler is only about 25% higher at $26 billion? Well, to be honest, I don't really see a great reason for it. And so personally, I would put this as a stock that I would bet against actively. Now, I know normally I talk about stocks positively in this list, but I wanted to talk about one that I actually go the opposite way on, to basically show that even though a stock price might be increasing a bunch, there can be reasons for that outside of the fundamentals of the stock being good. And in this case, I don't really see any anything great with the stock. And it seems like a lot of their branding around AI probably isn't true, because if they were actually offering valuable AI services, their revenue would be growing. But you clicked this video to find stocks that you do want to invest in. So let's turn now to another stock that I do own, which operates a little bit differently from a lot of the stocks we've looked at so far, since they aren't selling IT directly. Instead, this company is building a platform for productivity itself, Monday.com. Monday.com has not seen the same massive run-up that some of these other companies have, with their stock price increasing by only 39% over the past year, to a current valuation of just under $10 billion. Monday.com builds a platform to make working more efficient. They offer various products in areas ranging from recruitment to marketing to developing new software. They're basically the ultimate project planning tool. One of the advantages that they have over other competitors in the space is how flexible these platforms are. It's super easy to customize, and you don't have to worry about modifying the code directly. And it's relatively easy to build on automations and AI. And the reason we know this is working is because of how profitable the company is becoming. A year ago, they had negative profitability, but they were growing at 50% per year in terms of revenue. Today, they've reached $200 million in revenue, growing 35% per year, but their net income is positive and they have positive free cash flow, meaning this company is emerging from being a fast-growing startup effectively and into a fully mature company that maybe one day could even be in something like the S&P 500. As we see more people move to remote working environments and try to collaborate with each other from long distances, project planning software and productivity tools like Monday.com are going to increase in importance. And because companies integrate this directly into their core workflow, once a company signs on, they're not very likely to leave. And they're probably getting more value than they're paying, so it makes them extremely sticky. That's one of the reasons I bought 70 shares in this company, currently valued at $12,900, and it's basically flat, but it's up around $1,200 overall, which leads us to my number one highest conviction stock in the entire market that is riding the twin trends of AI and cybersecurity, and that stock is CrowdStrike. I currently own 100 shares in CrowdStrike, currently valued at nearly $30,000, but what's crazy is I only put $13,000 into it. This stock has just grown so much that it's become my largest stock overall. I mean, just look at that stock price increase. CrowdStrike offers cloud-native, AI-powered cybersecurity. So a traditional antivirus basically has a database of all the previous attacks that have ever occurred, and it can look at a piece of incoming traffic and say, is this the same as a previous attack? And if it is, it can block it. CrowdStrike, on the other hand, uses AI to detect patterns in potential threats so that they can mitigate them before they happen, which in the case of the SolarWinds hack, which was one of the biggest breaches of all time, hitting organizations as large as the Department of Defense, CrowdStrike actually mitigated this attack for their customers. CrowdStrike is kind of the opposite of MicroStrategy. They've been talking about AI basically as long as they've existed. They're not just focused on it ever since ChatGPT came out. The company builds itself into three basic layers. You have your agent at the core, which is surrounded by a data layer, including their threat graph technology, and built around that are their machine learning and behavioral AI tools. And then on top of that, you can actually build your workflows and develop on top of it. CrowdStrike is rated in the top right quadrant for Gartner for endpoint protection, ahead of Microsoft and SentinelOne. They're considered a leader in cloud workload security, and they're even one of the leaders in the world of risk-based vulnerability management platforms. Because CrowdStrike is able to play across all these different areas, they have some competitive advantages. And because they're a cloud-native platform, meaning they were built up from the bottom on the cloud, they're better at working with cloud workloads than a lot of legacy security providers. And we've already seen how fast the cloud market is growing. That benefits CrowdStrike. We've also seen how fast the AI landscape is changing. And as we start to see things like generative AI-created viruses, you're going to need AI tools to combat those. And CrowdStrike is perfectly positioned to handle both of those trends. The company is also making almost $1 billion in revenue every quarter while growing at 32% year over year, which is absolutely crazy. The company is profitable, they have high margins, they make a ton of cash. What's not to like with this stock? And I also promised I'd show you my entire stock portfolio as well as any trades that I've made in the past month. So I'm in my stock group here, and the two big trades I made were buying 100 shares in Palantir and then buying an additional 350 shares in Palantir after that. So if you haven't already watched this video, this is one of my favorite videos that I've ever made, and I think you'll really like it. Also, here is my entire stock portfolio on screen like I promised at the beginning.